Andrew, thanks for joining us. How was the performance of the Harmony funds last month?
Thanks, Richard. October was a reasonably good month for the Harmony funds.
Good.
The benefits of diversification really shone through over the month. We were mostly rewarded for a range of exposures to different asset classes and different investment styles over the month. And markets were quite volatile, and that presented an opportunity to us to add risk across the portfolio range.
Okay, what was kind of a representative return for the month?
The different portfolios returned between 0.5% and 1.5% in their respective base currencies over the month. Most importantly, we charted a less volatile course through markets during what was really a month of two halves. The first half of the month was good for more defensive assets, fixed income, etc.
Yep.
The second half was better for equities and more risk-orientated investments. The S&P 500 actually had its largest intra-month range in over 3 years, really highlighting how the volatility in markets over this period.
In terms of key contributors, what happened last month?
There were a few really significant contributors. Most importantly, our listed property and listed infrastructure exposures really paid off. Those two areas represent about 11% of each of the Harmony funds. Listed infrastructure was up 3% in dollar terms for the month. Listed property, our chosen manager there, was up around 6% or so in dollar terms, and year to date those two are both up around 12%, which is a really good return. So that really paid off. Also, the exposure to more growth orientated equity managers worked really well. All of those managers outperformed their respective indices during the month. So by that includes American Century on a global basis, held across all the Harmony portfolios. In the US portfolios, Wells and Granahan, and then also Henderson and Lindsell Train also have some exposure to that in some of the other portfolios. Granahan in the US small cap area was one of the top performers across the portfolios. They were up 8% for the month, and indeed are up around 12% or so in dollar terms since we first invested 6 months ago, significantly ahead of both small cap and large cap US equity indices.
Okay, was there anything in particular that didn't work in October?
The main areas that didn't work out really were on the equity side of things, exposure to materials and energy orientated sectors. Those sectors significantly underperformed over the month versus other sectors. The investments that we have that have the most exposure to those is the Copernic Global All Cap Equity Strategy and also the iShares Gold Producers. Both of those declined reasonably significantly over the month. We think there's a lot of potential upside to those investments, but we recognise there's a lot of risk, as was evidenced last month, and therefore we control that risk through position sizing. Therefore, those positions only represent less than 3% of all of the portfolios.
Okay, finally, Andrew, what are you looking to do in the portfolios?
So, as I mentioned, there was quite a bit of volatility in markets last month, and so we took advantage of that. We are adding to US short duration high yield.
Okay.
People may remember that we've had a lot of high yield exposure in recent years, but largely, entirely sold out of that around the turn of the year on valuation grounds. Now valuations have backed up significantly and yields are a lot more attractive. Short duration high yield offers a 4% yield in dollar terms, so that's given us the opportunity to go back at a much more attractive level. We also use the pullback in markets to add to equity exposure, particularly UK equity exposure, given that that's an area that looks more attractive on a relative basis versus other markets, and we chose to implement that via the Schroeder recovery strategy, which we added there. Those investments have been funded from cash and through a reduction in our infrastructure holding in light of recent strong performance.
Andrew, thank you very much.